The bank that broke the world. On September 15, 2008, at exactly 1 minute past midnight, Lehman Brothers Holdings Incorporated filed for Chapter 11 bankruptcy protection in the Southern District of New York. With assets worth over $600 billion, it became the largest corporate collapse in American history. But this wasn't just another business failure. Within hours of Lehman's announcement, global stock markets began hemorrhaging value at unprecedented rates. The Dow Jones plunged over 500 points in a single day. Credit markets seized up completely as banks stopped lending to each other, terrified that their counterparts might be the next to fall. What the world didn't know yet was that Lehman had been cooking its books for years, hiding over $50 billion in toxic debt through an accounting trick so brazen it would make Enron's executives blush. This is the story of how one investment bank's desperate gamble to survive became the match that ignited the worst financial crisis since the Great Depression. The roots of Lehman's downfall stretch back to 1850, when German immigrant Henry Lehman opened a dry goods store in Montgomery, Alabama. His brothers Emanuel and Mayer soon joined him, and Lehman Brothers was born. For over a century and a half, the firm survived the Civil War, 2 world wars, the Great Depression, and countless market crashes. By the 1990s, under CEO Dick Fuld's leadership, Lehman had transformed from a conservative regional firm into Wall Street's 4th largest investment bank. Fuld, known as the Gorilla for his aggressive management style and intimidating presence, had turned Lehman into a mortgage powerhouse. Between 1996 and 2003, the bank's real estate holdings grew by 850%. They weren't just financing mortgages anymore. They were packaging them into complex securities called mortgage-backed bonds and selling them to investors worldwide. When the housing market began its meteoric rise in the early 2000s, Lehman doubled down, borrowing massive amounts of money to buy even more real estate assets. By 2007, for every dollar of capital the bank actually owned, it had borrowed $31 more. This leverage ratio was among the highest on Wall Street, making Lehman incredibly vulnerable to any downturn in property values. The first cracks appeared in February 2007, when New Century Financial, one of America's largest subprime mortgage lenders, filed for bankruptcy. Home prices, which had been climbing relentlessly for nearly a decade, suddenly began falling in major markets across the country. Lehman's massive portfolio of mortgage-related investments started bleeding value. In the second quarter of 2007 alone, the bank lost over $2.5 billion on its real estate holdings. But instead of cutting losses and reducing risk, Fuld made a catastrophic decision. He ordered his team to buy more distressed mortgage assets, betting that housing prices would recover quickly. Lehman acquired 5 mortgage companies in 2007, including BNC Mortgage and Aurora Loan Services, adding billions more in toxic loans to their balance sheet. Internal emails later revealed that senior executives knew these acquisitions were dangerous. Chief Risk Officer Madeline Antonchik repeatedly warned about the bank's excessive exposure to real estate, but her concerns were dismissed. In one particularly damning message, she wrote that Lehman's risk management was fundamentally flawed and that the bank was flying blind. Her warnings fell on deaf ears, and she was eventually marginalized and forced out in early 2008. As losses mounted through 2007 and early 2008, Lehman's leadership faced a terrifying reality. The bank was running out of capital, and its creditors were demanding higher interest rates to compensate for the increased risk. In a healthy financial institution, this would have triggered immediate action to raise cash or reduce leverage. Instead, Lehman's executives chose deception. They employed an accounting maneuver called Repo 105, a technique so controversial that no American accounting firm would sign off on it. The scheme worked like this. Just before each quarterly reporting deadline, Lehman would temporarily sell approximately $50 billion of its worst assets to other financial institutions, with an agreement to buy them back days later. Because these transactions were technically sales rather than loans, Lehman could remove the assets from its balance sheet, making the bank appear much healthier than it actually was. The moment the quarterly reports were filed, Lehman would repurchase the same toxic assets, and the debt would reappear on their books. To make this scheme work, they had to use Linklaters, a British law firm, because no American legal team would certify that these transactions qualified as true sales under U.S. accounting standards. The Repo 105 fraud was orchestrated at the highest levels of Lehman's management. Chief Financial Officer Aaron Callan worked directly with Global Financial Controller Martin Kelly to execute these transactions. Internal documents show that Kelly specifically instructed subordinates to use Repo 105 aggressively to reduce leverage ratios before each quarterly filing. In one email, he wrote that the goal was to bring their leverage down to a more palatable number. The scheme was so systematic that Lehman had a standard quarterly calendar marking exactly when to execute Repo 105 transactions for maximum accounting benefit. During the critical period between the fourth quarter of 2007 and the second quarter of 2008, Lehman used Repo 105 to hide between $38 and $50 billion in assets each quarter. This wasn't a case of pushing accounting rules to their limits. It was outright fraud, designed to deceive investors, regulators, and creditors about the bank's true financial condition. The Securities and Exchange Commission later found that without these accounting tricks, Lehman's leverage ratio would have been reported as significantly higher, potentially triggering earlier intervention or forcing the bank to raise capital much sooner. While Lehman's executives were busy manipulating their books, the broader financial system was unraveling. In March 2008, Bear Stearns collapsed and was sold to J.P. Morgan Chase in a government-orchestrated rescue. This should have been a wake-up call for Lehman, as Bear Stearns had a similar business model and risk profile. Instead, Dick Fuld publicly declared that Lehman was in much better shape than Bear Stearns, citing the bank's strong capital ratios, the same ratios that were being artificially inflated through Repo 105. Behind closed doors, however, panic was setting in. The bank hired Lazard Frères to explore strategic alternatives, including a possible sale or merger. They held discussions with Bank of America, Barclays, and several Korean development banks, but potential buyers were put off by Lehman's massive real estate holdings and uncertain asset values. Throughout the summer of 2008, Lehman continued reporting profits while hemorrhaging cash. In June, they announced a second quarter loss of $2.8 billion, but claimed to have raised $6 billion in new capital. What they didn't disclose was that most of these profits came from accounting adjustments rather than actual business performance, and the new capital came largely from selling stakes in the company at deeply discounted prices. The final act began on September 10, 2008, when Lehman announced a third-quarter loss of $3.9 billion and revealed plans to spin off its commercial real estate assets into a separate company called SpinCo. The market reaction was swift and brutal. Lehman's stock price plummeted 24% in a single day as investors realized the bank was trying to dump its worst assets. Credit rating agencies, which had been mysteriously supportive of Lehman throughout the crisis, suddenly began threatening downgrades. Moody's and Standard & Poor's warned that any downgrade would trigger immediate demands for additional collateral that Lehman simply didn't have. Over the weekend of September 13th and 14th, Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke orchestrated emergency meetings at the New York Federal Reserve Building, bringing together the CEOs of every major Wall Street bank. Unlike the Bear Stearns rescue, government officials made it clear that no taxpayer money would be used to save Lehman. They demanded that the private sector find a solution. Barclays emerged as the most serious potential buyer, but British regulators refused to approve the deal without guarantees that the UK government wasn't willing to provide. Bank of America, the other leading candidate, abruptly withdrew to pursue the acquisition of Merrill Lynch instead. When Lehman's bankruptcy filing hit the newswires at 12:01 a.m. on September 15th, it sent shockwaves through global financial markets that are still reverberating today. The bank's collapse immediately triggered a liquidity crisis that spread far beyond Wall Street. Money market funds, which had invested heavily in Lehman's commercial paper, suffered massive losses, and faced unprecedented redemption demands. The Reserve Primary Fund, one of America's oldest money market funds, broke the buck, meaning its share price fell below $1 for the first time since the 1970s. This sparked a run on money market funds nationwide, forcing the Federal Reserve to provide emergency guarantees for the entire $3.5 trillion industry. International banks that had lent money to Lehman or purchased its mortgage securities faced enormous losses. European institutions were particularly hard hit, as they had been aggressive buyers of American subprime mortgage bonds. The crisis quickly spread beyond banking to insurance, with American International Group requiring an $85 billion government bailout just days after Lehman's collapse. Credit markets froze completely as financial institutions stopped lending to each other, creating a vicious cycle that brought the global economy to the brink of collapse. The human cost of Lehman's fraud extended far beyond Wall Street trading floors. Within 6 months of the bank's collapse, unemployment in the United States rose from 6.1% to 8.5%, eventually peaking above 10% in 2009. Millions of Americans lost their homes to foreclosure as the mortgage crisis deepened. Global stock markets lost over $11 trillion in value between September 2008 and March 2009. Entire countries, including Greece, Ireland, and Iceland, required international bailouts to avoid sovereign debt defaults. The crisis triggered the deepest recession since the Great Depression, with global economic output shrinking by more than 5% in 2009. Governments worldwide were forced to implement unprecedented stimulus measures and bank bailout programs costing trillions of dollars. The Troubled Asset Relief Program alone committed $700 billion in U.S. taxpayer funds to stabilize the financial system. Even today, more than 15 years later, many economies have not fully recovered from the damage caused by the 2008 financial crisis. Interest rates in many developed countries remain near historic lows as central banks struggle to generate sustainable economic growth. In the aftermath of Lehman's collapse, investigators began piecing together the full scope of the bank's deception. The court-appointed bankruptcy examiner, Anton Valukas, produced a 2,200-page report detailing how Repo 105 had been used to systematically mislead investors and regulators. His investigation found that Lehman's auditor, Ernst & Young, was aware of the Repo 105 transactions, but failed to adequately investigate their accounting treatment or challenge their appropriateness. Internal Ernst & Young documents showed that the accounting firm had raised questions about Lehman's quarter-end balance sheet management, but ultimately decided not to pursue the matter. The Valukas report concluded that Lehman's executives, particularly Dick Fuld, Aaron Callan, and CFO Chris O'Meara, had reasonable grounds to believe that their public statements about the bank's financial condition were misleading. Despite these findings, no senior Lehman executive was ever criminally prosecuted for their role in the fraud. Dick Fuld invoked his Fifth Amendment right against self-incrimination when called to testify before Congress, though he did appear for a contentious hearing where he was grilled about his compensation and decision-making. The lack of criminal accountability became a source of ongoing public anger and contributed to the rise of the Occupy Wall Street movement. Civil lawsuits against former executives dragged on for years, with most settling for relatively modest amounts compared to the massive bonuses they had received while the fraud was ongoing. The broader failure to hold individuals accountable for one of the largest financial frauds in history remains one of the most controversial aspects of the post-crisis legal response.